In March 2026, a war broke out in the Middle East. Not a skirmish, not a proxy conflict, an actual war. Bombs, oil facilities on fire. The Strait of Hormuz closed for the first time in modern history. 20% of the world's oil supply gone overnight. And you know what the S&P 500 did? It dropped 8% and then came back within weeks, while people were dying, while gas prices were spiking, while the IMF was downgrading global growth forecasts. Wall Street looked at all of that, shrugged, and went back to making money. And here's the thing nobody is saying out loud. That's not a glitch. That's not investors being heartless. That's the stock market working exactly as designed. And once you understand why, you'll never look at your 401k, your savings, or the evening news the same way again. In the next 10 minutes, here's what we're getting into. 1. Why the stock market almost never crashes when a war starts. 2. What Wall Street is actually afraid of, and it's not missiles. 3. Who's quietly making a fortune while you pay more at the pump. 4. Why markets not caring about war should genuinely scare you. If you've ever wondered why the world feels like it's on fire, but your brokerage account looks fine, this video is for you. And if you're new here, hit subscribe. I promise it's worth it.
Let's start with history, because the pattern here is almost uncomfortable in how consistent it is. Pearl Harbor, December 1941. The US gets attacked directly. The Dow drops 3% the next day. Within 2 months, it had recovered everything. Korean War, 1950. Market dips briefly, recovers within a year. Gulf War, 1990. Iraq invades Kuwait. Oil spikes. Market sells off about 20%, but that's the recession talking, not the war itself. Once the air campaign started and it became clear the US was going to win fast, the market ripped higher. 9/11, the worst attack on American soil in modern history. Markets close for a week, reopen and drop 7% in one day, and then recover fully within a month. Russia invades Ukraine, February 2022. Market drops, recovers. Iran War, March 2026. Market drops 8%, already bouncing back. You see the pattern. Every single time there's a major geopolitical event, war, attack, crisis, the initial reaction is fear. Investors sell, headlines scream, and then, almost every time, the market comes back. So why? Because wars, as horrifying as they are for human beings, are actually pretty predictable for financial models. Here's what I mean.
The stock market is not a moral institution. It doesn't have feelings. It doesn't watch CNN and feel sad. What it does is price risk. And risk, in financial terms, has a very specific meaning: uncertainty about future cash flows. A missile hitting an oil refinery? That's terrible, but Wall Street can model it. They can look at oil supply, estimate the disruption, run scenarios, and price it in, usually within 48 hours. What markets genuinely cannot handle is unknown unknowns, things they can't model. Think about March 2020, COVID-19. The market dropped 34% in 33 days. That's one of the fastest crashes in history. Why? Because nobody, not Goldman Sachs, not the Fed, not a single hedge fund, knew what was happening. Would cities shut down for 2 weeks or 2 years? Would people stop spending entirely? Would the banking system hold? That's what real panic looks like. A war in the Middle East? Markets hate it, but they can work with it. They know the playbook. They know energy prices spike. They know central banks respond. They know there's usually a resolution. So the first thing Wall Street asks when a war breaks out isn't how many people are dying. It's 3 questions. 1. Does this affect U.S. corporate earnings directly? 2. Will this force the Fed to change interest rates? 3. How long is this going to last? If the answers are not really, maybe a little, and probably not forever, the market stabilizes fast. And that cold-blooded calculus is exactly what happened in 2026.
Here's where it gets uncomfortable. While average Americans are paying $5 a gallon at the pump, while grocery bills are creeping up because fertilizer prices are spiking, while the Fed is stuck between raising rates and tanking the economy, some people are doing very well. Defense stocks, companies like Lockheed Martin, RTX, Northrop Grumman. Every time there's a conflict, governments spend more on weapons. The US defense budget goes up, allied nations start buying more American weapons. These stocks often outperform the broader market during wartime. Energy companies. When the Strait of Hormuz closes and oil spikes 30–40%, every barrel that American energy producers pump becomes worth dramatically more. ExxonMobil, Chevron, smaller shale producers, their profit margins explode. Commodity traders, the firms that trade oil, natural gas, wheat, fertilizer, they make money on volatility itself. It doesn't matter which direction prices go, the swings are the profit. And here's the thing, all of these companies are in your index funds. If you have a 401k that's invested in the S&P 500, you own a piece of Lockheed Martin. You own a piece of ExxonMobil. So in a very real sense, part of your retirement is quietly benefiting from the same war that's making your commute more expensive. I'm not saying that's good or bad. I'm saying most people don't know it's happening.
Okay, so here's the part I actually want you to sit with. The fact that markets don't crash during wars isn't just an interesting historical pattern. It reveals something about what the stock market actually represents and what it doesn't. The stock market is a measure of corporate profit expectations. That's it. It is not a measure of human welfare. It is not a measure of economic security for average people. It is not a thermometer for how the country is actually doing. And the gap between those things is getting wider. When a war breaks out and your gas bill goes up 40%, that directly hits your purchasing power. It hits your budget. It hits your stress levels. But if the companies in the S&P 500 can pass those higher costs on to consumers, or if defense and energy stocks offset the losses in other sectors, the index holds up just fine. The market can be flat or positive while millions of Americans are financially worse off, and nobody on financial TV will call that a crisis, because by the only metric they're watching, nothing went wrong. That's the thing that should unsettle you. It's not that a crash is coming, it might not be. It's that the scoreboard we've all been told to watch, the one tied to our retirement accounts, our economic confidence, our sense of whether things are okay, is measuring something fundamentally different from whether your life is getting better or worse. The stock market didn't flinch when a war broke out, and the reason it didn't flinch is the same reason your paycheck doesn't keep up with inflation, the same reason healthcare costs keep rising while hospital stocks hit all-time highs, and the same reason a recession that destroys small businesses often barely shows up in the index. The market is doing its job. The question is, whose job is it doing?
I want to be clear about something before you close this video. I'm not saying don't invest. I have money in index funds. Most smart financial advice still points in that direction for regular people. What I'm saying is understand what you're invested in. Understand what the scoreboard is measuring, and be deeply skeptical when someone on TV says the market is up so the economy is fine. Those are two different sentences. If this video made you think differently about something you thought you already understood, that's exactly what this channel is for. I'm a former investment banker. I spent years inside the machine, and the whole point of being here is to explain what that machine actually does, without the jargon, without the spin, and without pretending it's simpler or more benevolent than it is. If that's the kind of content you want, hit subscribe. New video every week, and if you want to go deeper on any of this, the links are in the description. See you in the next one.